It's the first roundtable session that we have by Phillip Capital Malaysia. Our topic for discussion today is Reset, Realign, and Prosper, your investment plan for 2025. We are honored to have two speakers with us from different distinguished fund houses. The first speaker is Mr. Ang Beng Guan. He's the head of fund management from Hong Leong Islamic Asset Management Sdn Bhd. Mr. Ang Beng Guan joined HLAM in February 2021 and was transferred to HLISAM on 1st September 2021 as head of fund management. Mr. Ang has more than 8 years experience in global treasury markets, dealing with money market, foreign exchange, and derivatives. He was a fund manager and investment strategist for an institutional buy-side investors managing close to RM 1 trillion in AUM. He also spent over 4 years in capital markets, driving private debt, corporate restructuring, and commercial real estate private debt funds, and managing emerging markets public debt portfolio. Mr. Ang holds a Bachelor of Science in Biohealth Sciences and Masters in Economics from University of Malaya. He had completed the Leadership Development Program for NUS in 2018. He holds a PKMC license holder and had also attained his CMSIR license from the SC since 7th May 2021. We are also pleased to introduce Mr. Azman Mosli, the Portfolio Manager, Global Equity at Nomura Asset Management Malaysia. Mr. Azman Mosli joined the Nomura Asset Management Malaysia as Portfolio Manager since January 2023. Prior to joining the company, he worked at Public Mutual Berhad, where he was responsible for managing global equity portfolios and overseeing research of Europe and Indian equities. Mr. Azman Mosli held various roles within investment for his tenure at MBU Capital, Laban Reinsurance, and RHB Research. He started his career as an analyst at Tronas. He holds a Bachelor of Science degree with specialization in mathematics and economics from UC Alberta, Canada. He's a CFA chartered holder. Let's start with the first question. Allow me to pose this question to you, Mr. Ang, on Trump. Basically, we all know that on his first day of his second term, President Trump quickly implemented policies focused on border security, inflation, trade, energy, and immigration, while also withdrawing from global agreements like the WHO and Paris Climate Pact. These actions align with his campaign promises and reverse many of the President Biden's policy. Mr. Ang, how do you think these executive orders will shape the political landscape and influence public opinion in the coming months? Over to you.
So basically Trump, right, is no different than the first term Trump that he took office back in 2018. But more likely that his policies will be on steroids. So essentially is that for Trump, right, this time around, right, his approval rating had somewhat slipped already in February. As of the composite polls has shown that right now he's closer to 48% on a post-presidential election rather than closer to 50% when he's during his campaign period in November or prior to November. So basically for Trump, right, essentially is that he's not the highest approved rating among the list of US presidents, right? And also he's not the lowest as well, so he's somewhere in the mid-league. But as compared to other presidents like John Kennedy, Jimmy Carter, or Bill Clinton, right, who garnered, right, since their presidential election, right, of 50% approval ratings above Trump, right? So Trump's not to say that he's getting quite ahead in terms of the majority. That's why he is also kind of like very cautious and very prudent in terms of what he's going to implement, especially on the trade tariff side as well. Also, right, in terms of his Republicans, right? So the Congress approval rating unexpectedly jumped. I mean, basically because right now, right, Republicans, right, in the Congress approval ratings has never hit above 20%. Now, I think it has hit above 20%. And basically right now, the average Republicans approval for the years, right, is throughout 29%. So right now it's closer to that level of approval ratings I think the reason why the Republicans' widespread approval ratings, right, is basically they are also looking that more towards more unified government from 2017 onwards. And basically is that Republicans also are more cautious itself during the Trump period right now. So I think that would signify very much in terms of the opinion going forward, not only on Trump approval ratings, but also on the Congress. So basically is that we could see that right now House Trump approval rating in terms of his job performance in handling immigration, foreign affairs, foreign trade, and also the Ukraine and Middle East crisis, right? So basically is that right now, right, he's also kind of like very middling as compared to other presidents as well, too, like Biden or Barack Obama or Clinton, also George Bush, as a matter of fact. So basically, that the approval rating is still very volatile, very fluid, but shown that partisans' approval tends to fade somewhat, right, after an initial honeymoon period, which is about 6 months to 1 year.
All right. Thank you, Mr. Ang, for your interesting analysis.
Yeah.
Mr. Ang,
So yeah,
yeah. Do you, or yeah, Mr. Asman?
All right. Um, okay. On Trump, basically, I think, yeah, like Mr. Ang mentioned, a lot of people also would know that the the election was a bit tight, although considering that the fact that it's red streak. But importantly, I think I would like to touch a bit more in terms of the market movement. So obviously, for the past couple of months, even before Trump got into his presidential position, I would say market has been volatile. There has been a lot of what we call Trump trades. So market, for example, was expecting for tariff. I think this was really anticipated by most of investors. And apart from that, they would know that Trump would likely reverse some of the things that have been done by um, the Biden's administration. For example, instead of going um, for green energy, focusing more on green energy policies, instead he is well known for his mantra of drill baby drill, which means they want to they want to drill more oil. So the reason being is that from investor point of view, um, also in terms of economic point of view, um, he need he actually need to do that in terms of pumping more oil from the states, mainly because his policy is um, very inflationary. Because his policies, I think even before this, his policies were very inflationary, mainly because of the tariff. And also you have a bit of relaxation in terms of regulation for drilling, for the financial sector, and this is quite inflationary as well. So to actually offset this inflationary impact from his policy. So that's why he's a strong advocate of for the US drillers to drill more oil. So it's not all negative on Trump. It's a bit negative in a sense that he is very unpredictable as a president. I think a lot of people would agree that he doesn't have the best personality in the world. Um, but I think if you look at it, even during his previous administration, market was volatile. But then if you look past through the next 6 months, 1 year, the market actually did quite good because his policies previously was uh, very growth driven. So, and I think now we haven't seen a lot of news on the growth part of his policy because he's quite busy on tariff. Uh, I believe like on tariff is just him being him, try to get bargaining power or a better negotiating position with Canada with Mexico, for example. It's part of his strategy, to get something out on border security, for example. Um, so I think, yeah, we are. We think that despite the volatility, the economic growth, importantly, in the US, I think is still quite healthy. Unemployment is still healthy. Inflation so far hasn't really picked up, but then again, we hasn't seen any of his policies being implemented. Um, but overall, we think that the economic environment in the US is still a bit healthy, but of course the risk is coming from Trump because of his trade policies, and then if there's a risk coming from countries that want to retaliate, so that would be another story. But I think the market is quite aware in terms of this risk coming from Trump. But if you look past through that, like I mentioned just now, and I would like to emphasize that the growth for US and even for the stock market, when I look a bit more detail in terms of earnings growth for US companies are still healthy. But if you compare to 2024, I would say it's slightly weaker than 2024. So I think all in all, we are still quite positive for US, just that we are more cautious because this time it's Trump, and yeah, and the economy is not as great as 2024. Yeah.
All right, thank you, Mr. Asman. I think I do concur that the state of economy for the US this year will likely to be more volatile. Of course, we may not be seeing 2023, 2024 kind of gains in 2025 because of the probably concerns of valuation, concerns of borrowing, and so on. Since we're on tariff, Mr. Ang, allow me to pose this question to you. Do you think that the market has fully taken the impact of tariff into the account? Because if we look at the US market, of course, recently there's been some profit taking, but probably that profit taking is related to the tech, the tech related stocks, the profit taking in the tech related stocks. Of course, across the board in Asia, if you look at Asia, China markets are doing still very well. If you look at MSCI Asia Pac index is also posting positive gains year to date. It seems to me that the Asia Pacific markets have yet to discount the impact of tariff. What's your opinion, Mr. Ang?
Yeah, the tariff impact, right, has not fully been priced in. Just to zero in on the question itself. And the reason is because tariffs can come in many forms also, in terms of in which part of the supply chain, right, does the Trump is looking at. And according to research by Robert Baldwin, a professor in New York as well, he says that the tariff would work effectively for Trump if its impact on the finished goods itself, right? Because the finished goods, right, is like making a country's imported good into US much more expensive, and thereby the US consumer would have a competitive advantage in terms of which kind of consumer goods, right, that they would go to based on their price sensitivities. But if a tariff imposed on the input level, for example, your basic chemicals, your semicon side, that would be detrimental to Trump's own economy also, because these imported goods will be relatively very expensive for those people who import it as part of their input to their finished goods, and thereby raising the manufacturing or the industrial capital cost. And these costs will have to pass on, right, to the consumers, especially the US consumers. So basically, that would be the inflationary side of it. We also have to see what Trump is going to do on the non-tariff side, especially in terms of negotiating with the European region on the digital sales tax as well, right? Because digital sales tax were introduced back in Euro area, and also it was imposed back to UK. Biden wasn't agreeable to it, but right now it falls on Donald Trump's lap or table. So basically, he is going to equivalentize it, the digital sales tax between the US and the European area. And according to research, right, basically, right now, Europe area tax, right, on US goods imported into the region is about 4.1%, 4.2%. And from the US side is the tariff imposed on European goods is about 3.5 to 3.6%. So basically is that there is about 4 to 5 percentage points difference. And if that's equilibrium it between these two regions, then there will not be much impact to it. But say, for example, Trump decided to escalate the tariffs, right, on digital sales tax, and especially certain goods for the European area, that side, right? So basically, it will be detrimental for the Euro region as well. And we also have to see what kind of goods and products he is going to impose there, right? Of course, the European area, the European governments also has their law, right? Especially the anti-coercion law, right? That they can use, right, to negate Trump's policies, right? But basically, there's not much case study on how the European bloc, right, will utilize this law to go and use it as a tool, right, to retaliate against Trump's policies. So yes, there are so many things that to available in terms of the tariffs and the non-tariff side of it. I mean, US can always, right, put anybody in the blacklist, right, for companies, US companies dealing with non-US companies, right? Once you blacklisted, right, it's very difficult to come in back into the US markets, right? So they can do that, right? So the straight answer is that basically no, the market has not priced in, and that has caused a lot of volatility in terms of the price action of what Trump is going to do in various aspects of tariff and non-tariff push. Yes, over to you. Thank you.
Yep. Thank you, Mr. Ang. Mr. Asman, would you like to add on? Do you think that the market has actually taken fully priced in the impact of tariff, or there could be some downside risk in the near term?
I would agree with Mr. Ang that um, the risk for tariff has not been fully priced in. Yeah, we have seen volatility here and there, but I think for the past 1 or 2 months, especially, um, it has been a bit more sophisticated in terms of drivers. So you have the news on DeepSeek, um, and then recently you have the news on Microsoft um, potentially cutting investment on data center. So these noises, when you add to the market, you can't really see clearly what are the impact from tariff, because the market reaction was because of um, a lot of factors and variables. For example, um, I think a lot of investors and even us, we had a view that software could do well because it's free from the tariff risk, for example. But then from that, you have the risk coming from DeepSeek, which is very unpredictable. So I think yes, there were a few sectors that have been obviously impacted by the risk of tariff. For example, automotive was hit badly. Um, Mainly because a lot of manufacturing of vehicles are done in Mexico. So that we could see a bit more clearly. But in terms of other sectors, it has always been a bit more complicated in terms of you need to know like a few drivers what are driving the sectors. So and market these days, I believe, are a bit more dynamic. So different sectors and even different stocks have their own idiosyncratic drivers. So yeah, I I think in terms of risk, yes, but there are pockets here and there where investors could hide, and then some of them are maybe overly priced in terms of risk. That could be an opportunity for investors as well. Yeah.
All right, great. Thank you, Mr. Asman. Since we are talking about risk, let's talk about IMF latest economic outlook. IMF highlight that in the medium term, the policy related disruption could be an added risk to the global markets, but there are also opportunities ahead. For example, if you look at the recent IMF projections on the global growth, it's 3.3% GDP growth in 2025. And that's mainly lifted by the upgrades in the US growth forecast from 2.2% to 2.7%. Across the pond in China, the growth projection was upgraded from 4.5% to 4.6%, and India remains steady at 6.5%. So, Mr. Ang, over to you. Within the countries, the regions that you cover, do you think that the US equities are still poised for a good growth this year? And what's your opinion on China and India as well?
I think US exceptionalism will experience short-term growth, right? But in the medium and long term, right, because of these tariff impacts and the increase in terms of their downstream production costs, right, which basically when they have to import all these higher cost imported inputs into their finished goods, right? We think that growth would slightly decline. And as shown, right, Bloomberg has estimated that growth to decline, right, by 2% in GDP, right, because of these tariffs. And S&P, right, assuming that they stay in place through the tariff through 2025, right, we can see that US consumer prices, right, who have a rise of 0.5 to 0.7 percentage points to their inflation, assuming that inflation right now is closer towards the 3 percentage point by the fourth quarter of 2025. So basically, all this dollar strengthening, currency adjustment, product substitution, right, along the way, right, may offer some relief for US, but it will be likely be short and very limited, right? So basically, is that depending on how Trump is going to negotiate his tariffs along the way, right? So it might have an impact towards the US over the intermediate to the long term, although we could see short-term strength in terms of the US market because of the dollar value strengthening, because of no shoring. Right now, we are not talking about friendshoring, reshoring right then. Now Trump is considering no shoring at all, right? So basically, he would want to bring back everything, right, and make America not great but greater again, right? So essentially, that is his purpose. And for China, right, I mean, basically, tariff imposed by US is important that we could look at, but we also have to be mindful of what is the retaliatory tariffs that China or the rest of the world, right, will have to impose on the US itself, right? Because it's the tit for tat game, right? You give me a joker card, I give you a king card or something like that, right? So essentially is that China has also announced closer to 21 billion worth of tariffs on US exports, right? Effective early of this February, right? Especially like coal and LNGs will face 15% tariff, and agriculture, machinery, it will face that kind of 10%. But right now it's still very de minimis. So essentially is that we are not sure what's the quantum that but China has already imposed quite a number of tariffs on US products scope. So for them to raise again the tariff ceiling, right, it will be quite limited as compared to the US, which they would want to increase substantially up to, some people are talking about 60 to 70% of tariffs on China EV products, right? So essentially that will be the focus, and it will be reduced the China's growth, right, by closer to about 0.5 to 1 percentage point for China itself. And in effect, US GDP growth will be impacted as well because of this retaliatory tariff, right? It will reduce the GDP growth and capital stock by 5 percentage point, and at least closer to 30,000 full-time jobs, right, will be cut because of these tariffs. So in the cumulative effect of this tariff on US GDP, right, could be as high as closer to 50 percentage point from the baseline expected level in 2025, which we expect the growth to be somewhere around IMF level, about 2.8% to 3.2%. And basically inflation, right, will be somewhat higher on the higher end, closer to 3.5%. And don't be surprised, we might see certain overshooting of inflation in the US somewhere in mid of this year, right? And with the expected shallower cuts by the US Fed, right? Essentially the US differential in terms of interest rate against the world, right, will be higher. So it will be a very challenging year for the world itself. And I think US has a bright spot, but eventually how the tariff work will impact its local economy. I mean, basically he pulls up a few of his contributions to some of the multinational entities, right, that he contributed for the rest of the world, right, it would impact him as well too, because these multinational funds, right, will also invest and help the US companies, right, to grow their companies, right, those who are lack funding and need funding from IMF, from the World Bank itself, right, they will be impacted as the US considering their contributions to the world itself, right? So all these, right, we have to take into account, and based on some of the estimator of the cumulative loss of this tariff effect, right, it will end up, the US economy will end up closer to 1.4 trillion losses by the end of 2028 if the tariff were to continue, right? Yeah.
All right. Thank you, Mr. Ang, for your analysis. We hear you on the retaliatory tariff, basically an eye for an eye. We also hear you on the US exceptionalism. We also hear you on strong dollar, likely interest rate will stay higher for longer. And that could probably impact the emerging markets like China, Asia, India as well, maybe Malaysia too. Over to you, Mr. Azman. Since we are now talking about emerging market like China, India, what's your take on China, India? Do you think that probably in terms of the performance, US equities can actually catch up eventually, or China and India after some profit taking recently in India, and now China is also back in radar after 3 to 4 years of underperformance within these three countries? Which is your topic?
Yeah, I can't really say much on India and China. But yeah, of course, we have seen strong performance from China the past year to date. But for me, the way I look at it, it has been coming from low base for the past 5 years, relative to the US. China has underperformed. And valuation wise for China, I would say most of the companies are quite attractive in terms of valuation. And for China, although we don't really look at it much, but I would say some of our investment in the US have obviously they have exposure in China, and we are somehow impacted by China indirectly. Um, so for China, I think for the past 3 years, valuation has been depressed. So it only takes um, a few improvement or a few good news. For example, last year at the end of the year, they came out with stimulus. The market, China market rally, but then it has been short-lived. Um, but the point I'm trying to make here is that the stimulus needs to be a bit more sustainable, um, which is a very important uh, thesis if you want to invest in China, to ensure that the rebound or the positive return is not short-lived. Um, so in terms of growth, solely looking at economic growth, China, of course, it has higher growth than the US. But I think the way you look at these two markets, it offers you two different things. You can't really compare like really developed market like US with China. I mean, it should be part of your diversification in terms of your portfolio where you have exposure to certain region. Um, and I think it would only natural if we assume that China could, looking at the year-to-date performance, China could perform better than US currently, because when you look at the risk from Trump, the valuation for US companies is not cheap. So from that angle, China could be looking more attractive than the US. But then um, if we were to look at in terms of structural growth, medium to long term growth. For example, technology drivers like AI, most likely you would get this kind of exposure in the US um, rather than China. To a certain extent, yes, you can get the exposure of AI from China, but it's in a different way. And I think in the US, the growth for tech companies, and especially if you focus on structural growth, you can just you can actually benefit from solely focusing on structural growth instead of a lot of noises. For example, government regulation, etc. So I think yeah, it's a safe answer. I wouldn't say China would perform better than US or US would perform better than China. Yeah, it's a very hard question to answer. Yeah.
Yep. Thank you, Mr. Azman. Yeah, we hear you on the opportunities and challenges in investing in global markets, of course. I think US and China are probably two economies that are probably cannot be ignored by the investors because of the size of the economy itself. And there are also a lot interesting opportunities within these two economies. Let's also talk about taxis. Just now you talk about the AI rally and so on. Mr. Azman, a follow-up question. What do you think are the upcoming themes within the tech space?
Yeah. I think for us, we are still pretty much positive on technology. I know it's a consensus opinion to like technology. Yeah, but the way I look at it, the runway for growth coming from um, AI, especially, it's still very early. Just that, as I mentioned just now, for the past couple of months, um, it has been there were noises, for example, coming from DeepSeek. But even if you look at it, on, for example, the news on DeepSeek. Um, if you look at the right sector or subsector within tech, there they are beneficiary of this event. So I would say because of the market volatility, stock picking is key, subsector picking is key, but overall growth for technology, I think it is here to stay, at least for artificial intelligence. And just to give you like a quick example on adoption of AI, why I mentioned that it's really in the early innings. So, for example, in US, if you want to adopt AI technology, first you would go through IT consultant. For example, if our company wanted to implement an AI technology, we would engage IT consultant to do feasibility studies on AI. So, what is your return on investment? I'm investing 1 million. What what is the efficiency that I could get out of it, or what is the additional revenue that I could get. So we follow certain companies, for example, IBM, Accenture. These are um, the big IT consulting companies in the US. And from the feedback is that out of 10 projects, so they are for the past 1 year, uh, the implementation or adoption in terms of AI project is still only at 1 out of 10 because a lot of companies are not willing to invest in AI, and partly because it is a bit more, it is a bit costly, and some companies couldn't really make the investment case of improvement in efficiency. So when so to add on this, when you look at DeepSeek, China um, came with this technology where they mentioned that we use less computation, our cost is a lot lower. I think this would actually benefit AI players because when your cost is lower, of course, we know that adoption would be faster. So for in terms of AI monetization adoption, I think actually DeepSeek was indeed a blessing in disguise, I would say, in terms of really, um, really becoming the driver in terms of making the AI technology to take off sooner than what we expected. So, of course, within AI, there are a lot of pockets of opportunities. I think now, in terms of application for AI, a lot of companies are looking at agentic AI. Basically, it's more like a chatbot, but it's a lot more intelligent than your usual chatbot. Microsoft has this technology, and then you have Salesforce. So in terms of revenue contribution for all this agent AI or AI related, is still very, very small. But the growth is very significant. They are growing at 40, 50%, which actually adding to the top line growth of these tech companies. So that's why earlier I mentioned that I think AI technology is still in a very early stage. Looking at these companies, the investment that they made, for example, you look at the hyperscalers, Meta, Alphabet, Microsoft, they have put uh, a lot of money into investing in data center AI related investment. Yeah.
All right.
Can I
Yeah.
add, Kim?
Yeah.
So I might take a little bit of curveball to the market view on technology, and I shifted towards somewhat of a neutral, cautious ground. I mean, basically, we have seen, right, that AI is a formidable tool, right, for countries to come together to the bargaining table, and it's a chip for either China or US, right, to negotiate on what they want, right? Otherwise, there will be a very granular limits in terms of who and what can search AI, right, on the inputs, right, in terms of the supply chains, right, from downstream to upstream, right, could be used for different industrial use, military use, as well as consumer use as well. As we have seen that Biden has come out with the GPU restriction limit, and that is the first step, right? We have not seen that basically is that what other things that both China and US, right, is looking at, right, in terms of trying to restrict the use of high tech, right, or the upstream side of the electronics, right, into their consumer, into the mainstream as well too. Number two, that has, as my colleague Asman has mentioned, AI is still relatively quite in the infancy stage, and a lot of hype going on in terms of the AI usage and how we utilize AI, right? But the thing is, has any technology in its infancy stage, right, in its cradle form, right now, right? So the idea of whether how much monetization we can get from AI, right? Because right now we can see, DeepSeek can do a lot of things, right? And because of the capabilities of DeepSeek, right, now governments are thinking what kind of rules, what kind of regulation, what kind of sandbox they're going to impose on this AI usage, right? And some are very fearful, some are receptive, depending on the government's regulations and what do they think about this AI technology and its impact on its domestic security, right? That's the most important thing, right? So essentially is how this AI can either be a tool for infiltration of the information or more towards their mainstream, or it could be an additional border checks, the border gates for them, right? And at best, it could be viewed as it could be competing with their own technology. At worst, it could be more towards a security threat. So that is the concern of the use of AI. So I'm more towards on a cautionary note, taking a little bit of cautious and prudent turn on IT views, sector view itself.
Yep. Thank you, Mr. Ang. So we hear from both Mr. Asma and Mr. Ang on the opportunities and challenges within the AI space. I think there have been a lot interesting developments like what Mr. Asman mentioned earlier. But of course, Mr. Ang opined that he's taking a more cautious approach in viewing the development within the AI space. And I think not only Mr. Ang, the Malaysian market has also in taking a hit as a result of the latest development from DeepSeek, that the capex, so-called capex requirement, committed by a lot mega tech firms are now being in question. Malaysian market was hit as a result of the development that we see earlier. Since we are talking about Malaysian market, Mr. Ang, you are the expert. We all know that. What's your view on Malaysian market moving forward after we have seen some profit-taking activities recently?
Okay, so I'm still learning about the Malaysian market. I mean, there's always a new day to learn, right? And every day is new thing, right? As my colleague Aspan are cognizant about, and the markets are always dynamic, right? The Malaysia side, I think there's still potential growth in terms of despite all these trade wars and tariffs, right? There is potential growth in terms of certain sectors, right? That maybe we could look outside or diversify outside of the mainstream sectors that we are kind of acquainted with, for example, technology and data centers, right? For Malaysia side, I think data centers for us, we are still very much in the infancy side. We don't use a lot of hyperscalers that requires a lot of GPUs. So in terms of US GPU limits and restrictions on Malaysia side, I personally view that it will be kind of like limited. And basically, for us to scale up to the higher end of the GPUs, right? So it would take a couple down 5 years to 10 years down the road, right? So right now, most of the data center plays are more towards property play and construction play rather than building the asset and utilizing and harnessing the power of AI, right? So essentially, we have heard land deals that is going on everywhere, right, in the southern state as well. In terms of the Malaysia side, I think I'm very constructive on Malaysia markets. I think Malaysia markets has long been kind of like emerging market look at, and the question of whether emerging market theme right is still there, right? Because after the COVID and also the aggressive Fed funds rate hike, right? I mean, basically that pulls all the fund away from the emerging market flows, right? So essentially, we could see that Malaysia market, right, could slightly rebound on the second half of it because right now the market dynamics are exhibiting signs of somewhat of a late cycle bull market, right? I mean, in terms of sectors why that are anchoring, right, the main boss are like financials, right, and also some of the construction companies, right, that perform really well in terms of their latest financial reporting, right. Other tech companies are slightly below, less of market expectations in terms of their financials as well. But basically, that is in terms of the price if, to earnings ratio, right? I think it has come back to somewhat of a less lofty valuations and coming back to more towards a median kind of thing. And that is a good thing, right? Because you don't want to buy somewhat very high price and a few years down the road you have to pay for that one single earnings, right? So essentially is that is part of it, right? I think Malaysia, right, would have a better build out that is coming up on the second half. And we think that the Bank Negara Malaysia would maintain the cost of borrowing at a very stable level. So it gives a little bit of certainty in terms of for manufacturing and industrials to plan out their capital structures as well too. And given the fact that yields has gone down, which I touched a little bit of fixed income, yields has come down. So right now is the best time for issuers to come out to the market, right, and start borrowing from the market, right, since the yields is so low, right, and everything is the spreads is so tight, right. So there's opportunities for the Malaysian market in terms of the earnings growth. For fixed income market, I think it will be slightly more of a richer side or premium side. Maybe Jasmine would like to pitch in, maybe from the global and how it impact the Malaysian side as well. A little bit.
All right, thank you, Mr. Ang. So we hear you on the opportunities in Malaysia market. Of course, I'm with my Bloomberg right now. KLCI is now trading at about 13.1 times PE, one standard deviation below the 10-year mean. So the valuation has actually come off from probably 3 months ago. So that is also a good thing because if there's any slight positive news on Malaysia market, we can probably have some we may probably see some re-rating in the valuation. On the fixed income space, Mr. also mentioned that probably there could also be some new issuance coming in as the yield remains very reasonable. Of course, Malaysian market is also driven by domestic institutions as well as some participation from the foreign investors as well as retail investors as well. Probably before we end the session for today, we would like to have Mr. Ang from Hong Leong Islamic Asset Management and Mr. Asman from Nomura Asset Management to talk about some of the products that they think that could actually benefit the investors. Over to you. Mr. Ang, would you like to start first?
Hi, so I kickstart first. So basically is that I don't want to name specific products, but I will quote a little bit of the strategies going forward that at least will help the retailers to be more on an informed decision making, given the fact that we are in a very volatile and uncertain tariff world, right? So basically, it's always good to look at funds, right, with strategies that give you a stable income, because that income, right, given the interest rate is going to be very stable and it's more inflationary, as my colleague Asman has mentioned, right? So you would want to retain the purchasing power of your investment as well too, right? So that income will be reinvested if, say, for example, inflationary pressure starts to comes in, then you would have a better reinvestment rate going forward as well. You look for some defensive strategies within the funds that is quite diversified with industrial concentration or sector concentration not more than 30% in any sectors. That will give you a good concentration and spread, less concentration, but more spread and diversification for you. And always look towards the global side, because yes, we are home buyers. We are very familiar, right, with all the stocks in the local bonds. But it's good also to take some of the global risk as well, because that global risk premium is still relatively attractive, right? Yeah, given the fact that you got the currency play and you got the growth play as well as the market play, right, from different offered by different markets, right, countries, right. So basically, is that you would want to diversify as much, and always do consider that kind of spread out strategies, right, going forward.
All right. Thanks, Mr. Ang, for sharing. Over to you, Mr. Azman.
Yeah. Yeah, just to add, from what Mr. Ang mentioned, because of the concern of the rates, similarly in the US, people are pretty much paying attention to rates expectation, which has reduced a lot in terms of interest rate cut. So this has actually added a lot to the volatility in the market. But from my previous investment talks, when it comes to global market investing, I would always take that opportunity, especially if you invest in a country like US, to buy on the weakness, not to sell on the weakness. If you look at the a longer time horizon, for example, 5 year, 10 year, at least for the past 5 year, developed market has outperformed the emerging market. So again, like Mr. Ang mentioned, you should have global exposure within your investment portfolio. So for Nomura here, we do have a few funds. So a more balanced fund is called Nomura Strategic Growth Fund. So it's a mixed balance of fixed income and global equity exposure. And then we do have Nomura Sharia Sustainable Equity Fund, which is basically a global developed market fund, but it is a bit more ESG focused. And I think the Malaysian market is always have a bit of wrong impression on ESG. When they think about ESG, it's lower return. But I think you can have a look at the performance. I think it has performed quite decently. And sometimes it's good to be ESG focused because you are restricted from investing in certain risky sectors. And lastly, if you want a normal, I would say, a proper exposure to global developed market, Nomura is the external fund manager for RHB Islamic Global Developed Market. I think the performance for the past 3 years have been quite decent. I think a lot of investors are quite happy with it. So this is quite a very well diversified fund. So if you want a bit of growth, because in the US, most of the exposure are a bit more focus in technology. So you have a decent 40% exposure in the US, but at the same time, you have exposure in defensive sectors such as healthcare. So even for us at Nomura, I think diversification is key when it comes to market volatility. So structural growth, you can always find it in other sectors as well. It's not always tech. I think people always think that when you want growth, structural growth is always technology. But as a fund manager, I think it's our responsibility to look at the fund in terms of diversification, looking at different angle of structural growth. Yeah.
Okay, just check out some of the Hong Leong funds available. I mean, we got our few distribution channels also. So we got various strategies to cater for your needs and investment horizons.
All right. Thank you, Mr. Ang and Mr. Asman, for your sharing. I think it's a very interesting session. We covered Trump administration and its impact on the market. We also cover a little bit on the emerging market equities and what are the opportunities and challenges within the Malaysia space. We would like to express our sincere gratitude to Mr. Ang Beng Guan, Head of Fund Management, Hong Leong Islamic Asset Management, Sdn Bhd, and Mr. Asman Mosley, the Portfolio Manager of Global Equity at Nomura Asset Management, Malaysia, for their time and consideration. We also like to thank to our audience for your continuous support to Phillip Capital. Stay tuned for the next Phillip Roundtable. Thank you.
Thank you, and